Alrighty, what's up, guys? Mal Sanchez with Portafolio Capital checking in again post FOMC meeting. Yesterday's release of the meeting notes. Fed decided to hold rates at 5.25% to 5.5%, and I'm kind of here to just dissect what that actually means for you, your money, if you have money in the market, if you have money in real estate. All these things are affected by what the Fed does, specifically with the Fed funds rate. So when you think of the perspective that the Fed has brought on in the past, let's say 4 years, post-COVID, the environment before, we'll again revisit, the environment before was increasing rates, and then the pandemic hit. Pandemic stirred things out of whack. And then the Fed decided, okay, we need to pause on increasing rates. So the logistics behind increasing rates is that it creates a constraint in the economy. And in terms of, it's the remedy to, when you have high inflation, it's the remedy to reduce the inflationary pressures that are affecting an economy. This is why they increase rates. This is why monetary policy exists. Again, we'll revisit dual mandate, price stability is the inflation question, and then maximum employment. Maximum employment and inflation are the two things that the Fed pays attention to. So yesterday's release of information came right after the CPI data hit the market. CPI data came in unchanged for the month of May, but year over year increased at 3.3%, which, when you think of it, if it's unchanged, then ideally whatever they've been doing to increase rates and then pause on the increase, the information, the data that's coming out is telling them that, hey, you know what? It's working. Inflation is slowing because there wasn't necessarily an increase year over year, and therefore they're starting to feel a little bit confident in the data. Now, their decision to not want to reduce rates is multivariable. If you think of a reduction, what a reduction in rates signals to the market. A reduction in rates signals to the market that there are weaknesses that are affecting either the dual mandate, jobs, or price stability. And so if there's a decrease in rates, then that's telling them that, hey, inflation is cooling too quickly, and we need to create a conversation around sparking the economy back up. So they didn't do either, right? They kept rates at 5.25%, 5.5%. And what that signals to the market is that, hey, the Fed is confident in how they're approaching the inflationary question and the inflationary remedy that they are focused on tackling. So with that being said, there's no increase in rates. However, in the meeting, the Fed, Chairman Powell, specifically noted a few things, right? Unemployment rate is still at 4%. Their projected unemployment rate through the year ending this year, I think, remains at 4%. And then in 2025, they project unemployment to increase just to 4.2%. So 20 basis points. And the other factor that's affecting it is PCE. So the last time we got data, I think, from PCE was in April. Their PCE data came in at 2.7%, core PCE at 2.8%. With that, they're still focused on getting to that 2% level. So it's not necessarily there yet, but they are feeling a little confident that the reduction from the 7% inflation that they were at, I think it was in 2019 to today, they're starting to feel a little confident because there has been that reduction from 7 to 2.7% today's PCE. CPI data that came out. CPI was, again, we're going to touch on that briefly, 3.3%, core CPI at 3.4%. CPI data tends to run a little higher than PCE, which is why the Fed decides to focus more so on the PCE number. With that being said, when we think of markets, the market has responded, the stock market specifically has responded well to whatever decision the Fed decided to make, which is a good sign because when the market responds to Federal Reserve monetary policy, that is an important. The Federal Reserve monetary policy is an important factor of what historically has either killed bull markets or have slowed them down. The fact that companies are still producing great earnings data, as we've seen in this past earnings season, specifically companies that are leveraged in technology, that are leveraged in anything that is associated specifically with AI, have responded well. We have seen some slowdowns in consumer spending, in housing. However, I don't think that that's been enough to really motivate the Fed to reconsider the tightening approach that they have to monetary policy. So keeping this restrictive stance in monetary policy, one, I think, in the market responding the way that it does, signals that, hey, the U.S. economy is doing well. It's doing great, and it's doing what it needs to do to reach that tackling of the inflationary pressures that are affecting or have been affecting us for the past 4 or 5 years. That's all I have for you today. I hope that kind of gives you some kind of glimpse into how we view markets and how we view monetary policy and its effects in how we position our portfolios here at Portafolio Capital Management. And I hope you join me on the next one, and we'll see you guys soon.